This week, we're talking cattle inventory and cattle on feed numbers. Welcome to the weekly livestock market update on Brownfield. I'm your host, Meghan Grebner. We're in for a special treat this week. We have both Kenny Burdine with the University of Kentucky and Charley Martinez with University of Tennessee this week to discuss I'm going to call it an exciting week of data and everything that economists have been looking for, right?
Lots to talk about, for sure.
I would agree.
We will get into the fun of those reports coming up, but first, let's recap what happened this week in the markets.
Sure. So another interesting week, several things to talk about. So 5 market average fed steer price was down 3% this week, 231.12 per hundredweight. August live cattle futures gained $3 on the week, coming in at 226.55. Box beef down again this week, down a little over $8, 366.68 on the week. August feeder cattle continue to impress, gained another $8 from last Friday, closing today at 331.95. National base hog carcass price was up $1.54 for the week, 104.84 per hundredweight. Pork cutout values were $3.52 higher this week, 118.86, and August lean hog futures gained 2% on the week, closing today at 108.58.
I want to talk a little bit about that box beef price, and I'll throw this up to either one of you who want to take it. We talk about it's consistently been moving higher, but in recent weeks, we've seen it continue to back down. What are you watching, and what does that potentially imply, or could it imply, as we're thinking about a declining box beef value?
Well, from my perspective, it's kind of a leading indicator. We're not seeing it on the cattle side yet. We're seeing, was this at least 2 or 3 weeks we've seen that box beef value pull back, and fairly significantly. Now, from obviously really high levels. The other thing I think we have to remember is where we are in the year. And, at this point, we're in late July. We've kind of gone through the Memorial Day holiday, the 4th of July holiday. So I think we also have to be open to the fact that some of that could be some seasonal pullback, although I will admit we haven't really seen that in the last few years. We've really seen prices stay pretty strong through the end of summer.
Conversely, on the hog side of things, we've seen some pretty supportive pork cutout values. Is it surprising thinking about the time of year as well?
I guess that's kind of the, what's the word? That's a bit of the paradox that we're seeing the pullback on the box beef and not so much on pork. And, those are, as far as substitutes go, I don't do a lot of work in this area, but, you tend to kind of track your 3 main meats that you eat, right? Beef, pork, and poultry. And beef and pork seem to have the most substitutability. By that I mean we tend to see them move somewhat together. So I think it's very possible we are seeing some substitution, which I think a lot of folks thought was very possible given price levels, right?
All right, let's take a look at the weekly slaughter numbers. Charley, you're up.
Yeah, so this week, cattle slaughter is projected to be right at 549,000 head, which is down 2% compared to last week. Comparing year to date, cattle slaughter is right at 6.5% below last year. And then on the hog side of things, hog slaughter was down just a little bit this week, coming in at 2.34 million head. Comparing year to date, hog slaughter is down 2.2% compared to last year. So I know I was on last week, and relatively speaking, when we compare year to date, we're seeing stable numbers. There was a couple of weeks there where the year to date difference was increasing on the beef side of things, but this week it was holding relatively steady, and same thing on the hog side.
I guess the cattle number running 6.5% behind year ago isn't that surprising. Are we a little surprised, knowing the production efficiency on the hog side of things, to see hog slaughter pull back, or is that not surprising when you're looking at it overall?
I think it's kind of getting back to what Kenny mentioned earlier, just on prices, where we see some seasonality. I think if you start thinking about just supply that was out there and kind of where we are in the year, I think that's why we're starting to see the pace that we're at. And I think some of that is also bleeding over into the prices that we're seeing that Kenny was mentioning. When you look at the paradox of tighter supplies, lower supplies of cattle, but yet the choice price is continuing to go down. I think that's showing us, it's not as much of a function of supply, but maybe seasonality and some seasonality demand that we're starting to see flex its muscle a little bit on the market prices.
Could margins for processors come into play in some of this too, as we're looking at total slaughter figures?
You want to take a shot at that, Kenny, or you want me to answer that one?
Doesn't matter to me. I think the answer is yes. I mean, I think you watch that box beef value as an indicator of their main income stream, right? Box beef values plus drop value are what really comes into play. So I think you're going to be watching that going forward. The other thing that we haven't talked about, and I don't really know what to make of it, but we're seeing higher quality grades in general, and percent prime has been running awfully high lately. I think we're in double-digit percentages, if I'm not mistaken. I haven't looked at that real recently, but I think that's right. How that may be weighing on the choice box beef value, I don't know, but it's worth pointing out just how many choice carcasses we're seeing right now.
I agree.
How much does our love of, knowing that the additional cover, the additional fat, right, that does that impact one subsequent markets or hamburger or some of those things? Is that a benefit on the consumer front long term too?
So I think higher quality definitely is a benefit to consumers. And then you ask about it's a benefit to consumer, but there's also obviously there's the additional value that brings to the beef sector. So it's, I think, consumers and producers. You ask about spillover or other impacts, Megan, but the truth of the matter is those higher grading carcasses, they do tend to lead to a fatter trim. So I think that partially explains our import levels, but I think it also probably explains these really strong cull cow markets, right? We're not moving a lot of cull cows. I think a lot of that cull cow market is kind of a trim, ground beef type market. So I think it's also why there's been a strong demand for cull cows.
I agree. I think if you just think about total volume of trimmings that's needed to make what the average consumer here in the U.S. likes, which is ground beef, you got to find it somewhere. And I think as Kenny mentioned, we're not slaughtering a lot of these cows and bulls. We've reached in pretty hard the last couple of years. And as Kenny mentioned a couple of weeks ago in the Southern Ag Today article, we're hitting pretty all-time lows with that in terms of volume. And if you look at the discounts for yield grade 4s and 5s, that's becoming to a point where discounts are nowhere near what they used to be. They're not hammering them as hard, and so there's some markets at work saying, hey, we got to find this trimming somewhere to make the ground beef that we need for the consumer. And I think that's also a subsequent impact of what we're seeing.
I ask this question all the time, but what about tallow and thinking about an increase in domestic use of fat through whether it's to fry your French fries in it or to put it in your skincare products. But we're seeing this resurgence and this popularity spike in utilizing beef tallow.
I think if you have an increase in a usage or an alternative use for tallow, that's nothing more than increased demand, right? So increased demand, increased prices. At the same time, you have the food product that they also produce in terms of ground beef. So I think you when you mention other avenues, other uses for tallow, that's another aspect to it as well.
Okay, several reports out this week. I will be honest, we're going to punt on the livestock slaughter report, which came out on Thursday, and cold storage, which came out today. So we'll leave that for Josh to tackle next week when he's back with us. We're going to take the big ones. July cattle inventory report out today. As much work as I do with Economist, I would say this is probably one of the most anticipated reports to get its return back since it was dropped off in 2024. Kenny, let's get into it.
Sure. So do I remember correctly from last week? Did Charley refer to this as Christmas in July for ag economists? Is that the phrase that was used?
That's what we're going to roll with.
I will tell you, when I was with Seth Meyer at USDA, he kept referring to it as his cattle inventory, the July cattle inventory report, and he was fighting for its return. So I know you all have been waiting for this for really 2 years.
Well, back by popular demand, the July cattle inventory report. But so a couple of things to point out, I think, before we get into the numbers. First of all, we didn't get this in January, or so we didn't get this in July of 2024. So, any changes are going to be 2-year changes, not 1 year. So don't confuse those. The other thing I like to point out, there's no state level inventory in this report. So in January, we'll get, inventory numbers for most states. This is going to be just national numbers. So we can't talk about regional implications and things like that out of the July numbers. Still, there's some things to talk about. So I kind of roll through the highlights and we'll talk about them. But total inventory of cattle and calves. So just, the big number, down 1.3% from 2 years ago, 94.2 million head. I like to look more at that beef cow inventory number. It was down 1.2% from 2 years ago, 28.65 million head. That was actually not down as much as some of the expectations were from some of the pre-report estimates. Heifers held for beef cow replacement. This was probably the number that I was most interested in seeing, down 3% from 2 years ago. So, that's certainly not a number that implies much heifer retention, which has been consistent with much of what we've discussed from quarterly cattle and feed reports recently. Two more highlights I'll mention. The 2025 calf crop was estimated at 33.1 million head. That's 1.4% smaller than 2023. And total on feed inventory, this was a little interesting to me, was actually only estimated down by about by about 0.8%. So not quite as much as we've been seeing in some of our monthly cattle on feed reports.
When you take a look at this cattle inventory report, does it show that let's just cut to the chase. We're still not, widespread herd expansion isn't happening.
Agreed. So when I look at it, a couple of things stood out to me, kind of going to the next level. The first one that's sticking back in my mind was, we have seen beef cow slaughter levels really high the last 12 months, especially the last 6-7 months. So I don't know this to be fact, but this is a 2-year change we're talking about. I think probably all of that decrease occurred from July 2023 to July 2024. I'm going to bet with the decreased slaughter, we've not seen much change in the last 12 months. We may have even seen a slight increase. We don't know that. We're just seeing a 2-year change. The other thing, so we had 100,000 fewer heifers January of this year being held for replacement than we did 2 years ago. That tells us something, but of course the cow herd's also smaller. So just kind of one way to think about calibrating that, if I can use that term, whereas a percent of beef cow inventory, we've actually got fewer beef heifers in the system being held for replacement purposes now than we did 2 years ago. It's not a huge difference. I think it's like 9.7% July 1 of this year, and it was 9.9 July 1 of 2023. But the point that I'm just trying to make is, as a percent of beef cow inventory, it's actually fewer heifers still.
Yeah.
Kenny, one of the things. Oh, go ahead, Charlie.
No, I was going to say, I think that's the one key takeaway is you get this one report after 2 years. And what I did was I went back to historical July 1 reports and was comparing percent or calculating the percent of heifers as replacements compared to the herd. And the last two that we've had have actually been the lowest that we've had in that report dating back to 1973. So I think that's one of the key takeaways that was kind of sticking out to me, because I think there's also a sticker shock a little bit where some folks might look at the inventory report for July and see total number of head and be like, well, hold on, did it go up compared to, because if you look at January 1, these numbers look like they're bigger. Is that expansion? Well, I think it's important to realize you got to compare July, January to January, because there's this nuance of cattle that were in one category, like a replacement heifer on January 1, could be moved over to a cow in July 1. And so it's one of those things where I think time of survey is important, and you got to remember comparing reports. Sometimes it could lead to false indicators of things, and the calf crop and the heifer percentage, if you calculate that, those are the two things that really stood out to me with this report. And I think it jives with the reports that we've been seeing from the cattle on feed. And if you monitor the National Feeder Calf Summary in terms of percent of heifers that are in those receipts, I think this kind of jives with what we're seeing.
Kenny, one of the things that we've talked about, and maybe I'm crossing over into other reports, is if we're going to see expansion, that likely is going to happen not necessarily from heifer retention, right? But like slowing down our beef cow slaughter. And I know we're not talking livestock slaughter this week, but how important is that figure going to be moving forward as we're looking at these month-to-month reports until we get to the January inventory report?
It's huge. If you look at how much beef cow slaughter is down, if we kept at this same pace, by that I mean if we ended the year at the same percentage below last year that we are right now, it would be a decrease in beef cow slaughter of more than 450,000 head. So that's a big number. So, I don't know. There's different ways to define expansion. And I think there's a really good chance that we see a slight increase in beef cow numbers come January 1 of 2026. But it's not going to be from heifer retention. It's going to be from the fact that we're simply not moving as well. We're not moving as many cull cows. And we've talked about some of the reasons why. I think high prices, interest rates, things like that. But folks are holding on to cows longer, I think largely because they anticipate a much higher value calf out of those if they get another calf from those cows.
All right, let's talk cattle and feed numbers. Charley, you're up next. One thing I think we should probably preface this is a quarterly. So we'll get percentage of heifers on feed as well, which we'll get into that conversation. But knowing that makes this report, I think, that much more interesting, paired up with that cattle inventory report this afternoon.
Yeah, Megan, I was gonna lead. This is one of those quarterly reports that gives us a little bit more nuggets that we can.
Sorry, I'm taking your thunder.
I mean, it happens, right? But in this report, it's one of the ones that we look forward to as well. So it's kind of nice that we get these two in the same day. So cattle on feed inventory came in about 1.6 below a year ago, which was a little lower than pre-report estimates. June marketings were down 4% from June of 2024. And that was also, close or on the mark when it came to expectations of the report. June placements were down 8% from 2024, which was much lower than expectations and outside the range of estimates that were being talked about before the report came out. Steers on feed were estimated to be 1% higher than July 1 of last year. And then if you compare that to the USDA NASS estimates, the NASS estimations had 5% decrease in the number of head that had heifers on feed. And so this report can kind of, give us some indication on that. So heifers as a percentage of cattle on feed inventory came in right at 38.1%. And this is about a half a percent or 8.5% lower than July 1 of 2024, but up about 0.5% from April of this year. So I think, Kenny, one time you covered this and you were talking about like the realm or the percentages that usually indicate not rebuilding, and you want to be in that lower 30s, higher 20% of heifers being on feed. And so it being at 38.1%, I think that's showing that, one thing for sure is that people are not keeping replacements, and kind of driving home what y'all were talking about just a second ago. I think if there is any slowing or stabilizing of the beef herd and any type of rebuilding or an increase of the calf crop for next year, it's going to come by way of the cows and the cow base that we have, not necessarily the replacement heifers that people have this year. And I think, as Kenny mentioned, I think high prices, they're probably inducing a lot of people to say, well, let's go ahead and get rid of her. And we have her mom. Let's go ahead and get her bred back, and we can have another calf next year instead of waiting 2 years to get a calf off of this replacement female. So I think that's kind of the unique thing. But then comparing to what the July 1 inventory report had versus the cattle on feed report, there were some pencil differences against them. So that was also the interesting thing for me looking at this report.
Placements, I want to start there, down 8%, which was pretty significantly outside of pre-report expectations. New World screwworm, what about grass pasture conditions? Are those two things that are maybe contributing to what we're seeing in terms of the placements?
I think that is, depending upon where you are, I think each one has its own impact. So, and I'll just use, if you're in an area that was in drought, if you remember last year, a lot of places were kind of in drought or having a prolonged drought or might be getting ready to come out of drought. So there was no need to keep holding on to calves from that standpoint. So we saw a lot of, placements last year, whereas this year, a lot of folks have rain or have had it rain, and a lot of folks have grass and forage available. And so, if they think about, where they want to be and in terms of pricing, whether it's the fall run or, positioning themselves for that, they could be, from a management standpoint, making that decision, saying it's better to just hang on and let's use the grass that we got and let's see what happens to prices. And I think if you're also more towards the border, I think that's where we see New World screwworm coming and having an impact. We know that historically the last 2 quarters of the year is when we bring in a lot of those cattle from Mexico. But that's still, that doesn't mean that we don't bring any in the first 2 quarters of the year, the first half of the year. And I think some of that, the border being shut down or, closing off that supply out of Mexico, I think is somewhat what we're seeing there in terms of impacting that lower placement number.
I would assume that obviously feed costs are reasonable for producers right now, much more so than they have been in recent years. But thinking about expansion or the lack thereof, how much does the cost of borrowing money come into play into that as folks may be considering to try to think about expansion, but knowing where interest rates are and knowing how expensive it is to borrow?
Kenny, you want to tackle that or me? I think you're on mute, Kenny.
My apologies to everyone. No, I think it's a big factor. You think about it, the last time we really grew the cow herd, 2014 to 2016, was kind of the big years. And we were doing so in an interest rate environment, not necessarily half what current interest rates are, but not far from it, right? And it's a very different world. And, I think about, we kind of think about that decision about, cull cows and heifer retention. I can do both, meaning I can cull and replace, or I can keep and retain. I can do both. And, you think about the interest, there's the cost if I'm buying breeding stock, right? There's also, though, by not selling that heifer calf, there's the capital that I don't have access to immediately, right? So maybe that's an operating line that I have to access a little more thoroughly because I don't have the cash from that heifer. And I think absolutely I'm more likely to sell her in a higher interest environment because it doesn't force me to tap into that line of credit that cost me more now than it did 10 years ago.
I think you also sprinkle in, if you want to go buy a female in the market, a replacement female or bred cow, bred heifer, the value of those animals is higher than it was also than 10 years ago. So not only is the cost of a dollar more expensive, but the animals are more expensive. It's probably, as we've been talking about, it's probably a disincentive from a management standpoint to go out and buy those. And I think that's where, in our parts of the world, from an extension standpoint, it's to the cow-calf producer, it's kind of like, hey, you're finally in a spot where cash is probably increasing on your balance sheet. Let's be smart about that moving forward, whether it's risk management like we always talk about on this show. But, as you start having cash on hand, let's be smart about it. You don't have to go buy the brand new John Deere that you have always wanted. But, I think it opens up an interesting conversation from a farm management standpoint of how to attack not only the rest of this year, but next year.
One last question for you before I let you guys go on this Friday afternoon. We've mentioned 2014, 2015 a couple of times. How much does the the historical lesson from what happened when we expanded in that time frame a decade ago sit rent-free in producers' minds as they're thinking about maybe trying to expand?
I think that's. Go ahead, Kenny.
Yeah.
Go ahead.
That was a pretty short-lived high price run, and I think everybody, including myself and Charley, I think expect high prices to last longer this time. But I do think some folks got burnt, and the ones that got burnt the worst were the ones that made some major investments in 14 and 15 with an expectation that cap prices were going to stay at those levels for a long time. You know, the other thing that I've mentioned to a few folks, and I don't want to get into specifics, but 508 steer calves in Kentucky went 7 years and 4 months with the state average price never being above $2 a pound. Now, you know, our viewers are from all over the place, so that number doesn't mean anything to them. But those same steer calves that are pushing $4 right now, you know, spent 7 years and 4 months under $2 a pound on average. And I think that has made a difference too, that we came through a really tough, 7-8 year period. And I think that's also one reason why folks are being cautious about expansion this time.
Yeah, I think there's that point that Kenny just made, but I think learning by fire from the last time is a big part of it, where we saw the ramp up happen really fast, across the country, and then the prices tanked really fast. And I think people are like, why would I go do that again? And I think because of the duration of bad prices, or I would say lower prices following that high run for folks, I think that also put, from a financial standpoint, probably in bad positions where they were having to not only keep increasing operating loan, but they were at some point struggling to keep up with their payments to a certain extent. And so I think, if you do that for a long enough period of time, you're going to learn that I should not probably put myself back in that position. And I think now that, we mentioned, you've got cash on hand, probably, your break evens and your profitability margins are probably more in your favor than ever before. I think people are like, hey, I like this. Let's not hurt ourselves like we did last time. And I think, there are going to be some folks that expand because they have the opportunity to, and it probably pencils out to make sense. But I think on average, a lot of folks are they learned from last time and don't want to put themselves back in that position again.
Gentlemen, it's great to see you.
It was awesome to see y'all.
You too. Thanks a bunch.
Let's do this again in 6 months, and maybe we'll let Josh in this time. All right. Next week, we'll talk ag prices. We'll touch on trade updates, because there's been some of those this week. And we will dig into the reports that we passed over this week. So have our weekly livestock market update delivered to your email box every Saturday. Go to brownfieldagnews.com. You can also submit questions and comments. And for market updates twice daily, make sure to check out John Perkins' Market Minute. Have a great weekend. I'm Meghan Grebner for Brownfield.